On the surface, everything looks fine. Stores are open, restaurants have wait times, airports are packed. If you judge the American economy by foot traffic alone, you might conclude the consumer is thriving, spending confidently, moving freely, living well. But there is a more precise instrument than foot traffic, and that instrument is the credit card statement. Because for the better part of 3 years, the American consumer did not stop spending. They simply changed how they paid. Cash and savings became secondary. Credit became the engine. And for a while, particularly through 2022 and 2023, that engine held. It absorbed inflation. It covered the gap between wages that were rising and prices that were rising faster. It was, in economic terms, the ultimate buffer. That buffer is now gone. As of the first quarter of 2026, total revolving consumer credit in the United States has crossed $1.1 trillion. The personal savings rate has fallen to levels not seen since the months immediately preceding the 2008 financial crisis. And credit card delinquency rates, the share of balances where payments are more than 30 days past due, have now surpassed their post-pandemic highs. These are not projections. These are published figures from the Federal Reserve, the Bureau of Economic Analysis, and the New York Federal Reserve Center for Microeconomic Data. And when you read them together, not in isolation, but as a system, they describe something specific. They describe a consumer who borrowed to stay whole and who is now running out of road. This is an analysis of how that happened and what it likely means for the quarters ahead. To understand the trap, you have to understand the rate environment that built it. Beginning in March of 2022, the Federal Reserve embarked on one of the most aggressive monetary tightening cycles in modern American history. Over the span of roughly 16 months, the federal funds rate rose from near zero to 5.25%, the highest it had been since 2001. The stated objective was to cool inflation, and in certain categories it worked. Shelter inflation proved stubborn. Services inflation proved stubborn. But the headline numbers eventually moved in the right direction. What the rate hikes also did, and this part received far less coverage, was mechanically transform the credit card from a convenience product into a compounding liability. Here is the arithmetic. The average credit card interest rate in the United States today sits at approximately 22% annually. That figure is not incidental. It is a direct transmission of Federal Reserve policy into the consumer balance sheet. When the Fed raised rates, banks raised the APR on variable rate credit products almost immediately. It is contractually permitted. It happened across the industry within billing cycles. Now apply that 22% to the average American household carrying a revolving balance, which, according to Federal Reserve data, is approximately $6,300 per cardholder among those who do not pay in full each month. The annual interest charge on that balance alone exceeds $1,300 per year, paid before a single dollar of principal is touched. This is the mathematical structure of the trap. Monthly minimum payments, which most consumers default to under financial pressure, are largely consumed by interest charges. The principal barely moves. The balance persists. And as balances persist, the compounding accelerates. It is not metaphorical to call this a spiral. It is a description of how compound interest functions on a negative balance at high rates over time. The Federal Reserve did begin cutting rates in late 2024 and into 2025. But the pace was cautious and the magnitude modest. Average credit card APRs did not meaningfully follow those cuts downward. The transmission mechanism that works swiftly when rates rise works considerably slower when rates fall, and in some cases, for credit card products, it does not transmit at all. Banks have latitude in how they price revolving credit, and in a tighter lending environment, that latitude tends to favor the lender. The consumer who borrowed at 18% in 2021 is not paying 18% today. In many cases, they are paying 22 or 23, on a balance that has grown, not shrunk. That is the mechanics of the trap. What is less visible, but arguably more important, is what is happening inside the balance sheets of the institutions that issued that credit. Because while consumers have been managing compounding balances, the banks that hold those balances have been making a series of quiet, structural adjustments that reveal a great deal about how they assess the road ahead. The first adjustment is provisioning. In banking, a loan loss provision is the amount a bank sets aside in anticipation of loans that will not be repaid. It is, in effect, the bank's internal forecast of how much consumer credit will go bad. Through 2024 and into 2025, the major card-issuing banks, Institutions whose earnings reports are public documents collectively increased their loan loss provisions by amounts that attracted little mainstream media attention, but considerable attention inside the credit markets. J.P. Morgan Chase, Bank of America, Capital One, Synchrony, each of these institutions publicly disclosed elevated charge-off rates and increased their credit loss reserves. Charge-offs, for context, are balances the bank has determined are uncollectible and has written off their books. When charge-off rates rise, it means the bank has concluded that a measurable share of what it is owed will never be recovered. The second adjustment is credit limit management. This is subtler, and it rarely generates headlines, but its effect on consumers is immediate. Banks have the contractual right to reduce a borrower's available credit limit without advance notice in many circumstances. And the data from consumer reporting agencies indicates this has been occurring at an elevated rate, particularly among subprime and near-prime borrowers, and among accounts that have exhibited signs of financial stress, late payments, high utilization rates, or balances that have not meaningfully declined over multiple billing cycles. When a credit limit is reduced, the available buffer shrinks. A consumer who is carrying $4,000 on a $6,000 limit is now at or near their new limit. They cannot borrow more. Their financial flexibility has been reduced without a single conversation, without a letter, often without anything more than a notification buried in an email they may not read for weeks. The third adjustment is underwriting tightening. New credit approvals for credit cards, personal loans, and auto financing have become measurably harder to obtain for borrowers below certain credit score thresholds. The Federal Reserve's Senior Loan Officer Opinion Survey, a quarterly report that polls lending institutions on their underwriting standards, has consistently shown a net tightening posture for consumer credit through 2025 and into 2026. Fewer people are being approved. Those who are approved are receiving lower limits at higher rates. This is the banking system responding rationally to the risk data it sees. But the economic consequence of that rational response is a contraction in the availability of credit at precisely the moment that a large segment of the consumer base is most dependent on it. History does not repeat precisely, but it does have structure, and the structure of what is happening in consumer credit today has meaningful echoes in two prior American economic episodes. The first is the early 1980s. Paul Volcker's Federal Reserve broke the back of double-digit inflation by pushing the federal funds rate to extraordinary heights, peaking above 19% in 1981. The consumer credit system contracted sharply. Households that had borrowed through the inflationary years of the late 1970s found themselves caught between high prices and high borrowing costs simultaneously. What followed was a recession of significant depth, though one that ultimately reset the inflation environment and set the foundation for the expansion that followed. The second parallel is 2007 and 2008, and it requires careful framing because the architecture is different. The 2008 crisis was fundamentally a crisis of mortgage credit, securitization, and institutional leverage. What is happening today is not that. Consumer credit is not packaged and distributed through the financial system in the same way that mortgage-backed securities were. But the behavioral parallel is instructive. In both periods, the consumer had used available credit to sustain spending patterns that income alone could not support. And in both cases, the moment of inflection came not from a single dramatic event, but from the gradual exhaustion of the credit buffer, from the quiet mathematical reality that the borrowing capacity that had sustained spending was reaching its structural ceiling. That ceiling is what we are examining now, not a cliff in the theatrical sense, a ceiling in the architectural sense. The room stops here. So what does this mean for the next 2 quarters? Consumer spending represents roughly 70% of United States GDP. That is not a rhetorical figure. It is the structural composition of the American economy, as measured by the Bureau of Economic Analysis. When consumer spending weakens, the economy slows. And consumer spending weakens when the capacity to spend, whether from income, savings, or available credit, is constrained. All 3 of those channels are currently under pressure simultaneously. Income growth has outpaced pre-pandemic averages in nominal terms, but when adjusted for the cumulative inflation of the past 4 years, real wage growth for median earners remains modest. Savings have been depleted, and credit, as we have examined, is tightening at the institutional level while compounding at the consumer level. The sectors most exposed to a consumer spending pullback are those most dependent on discretionary credit. Retail, hospitality, travel, automotive, and consumer electronics. These are not abstract market categories. They are the businesses that employ a significant share of the American working population. A spending contraction in these sectors tends to produce employment contraction with a lag of 1 to 2 quarters. None of this is certain. Economies are not deterministic systems. Labor markets have demonstrated a resilience through this cycle that has surprised many forecasters. The Federal Reserve retains policy tools it has not yet deployed. Fiscal intervention remains a political variable, and consumer behavior, while data-driven in aggregate, is not uniform at the individual level. There are segments of the American consumer base, higher-income households with low debt and intact savings, who are financially insulated from what this analysis describes. But the structural data is what it is, and what it describes, when read without the filter of optimism or pessimism, is a consumer credit system that is moving from expansion to contraction. The buffer that sustained spending through the inflationary period has been drawn down. The cost of holding that debt has increased, and the institutions that provide credit are tightening the valve. The American consumer is not finished. That would be an overstatement and an inaccurate one. But the mathematical conditions that allowed spending to run ahead of income, the conditions that held the economy aloft through a genuinely difficult inflation cycle, those conditions have changed. And when conditions change in the plumbing of an economy, the pressure eventually shows up at the surface. What we are watching right now, in the data, is the beginning of that pressure becoming visible. This is an examination of publicly available macroeconomic data and structural economic trends, offered for informational purposes only. If you found this analysis useful, if you want to understand the structural mechanics of the economy rather than just the headlines, subscribe to this channel.